Hey guys, this is Rudy. I'm coming at you live from Palm Beach in Florida. It is Friday. It is November the 17th. We're halfway through November. Lots and lots of companies have already reported. I hope your portfolio is doing okay. Yesterday, we saw a huge crash in the energy market because of China and too much supplies or something. And today, that just reverses again because China, too much supply, and all that kind of stuff. Anyway, I don't really want to talk about that today. What I do want to spend a few minutes chatting with you about is endowments and foundations. I thought, you know what? Many people study the 13 Fs in the United States, and you can see what your favorite large institutional investors, like all these super duper hedge funds like Berkshire Hathaway and private equity firms, Pershing Capital of Bill Ackman and companies like that, what they invest in, perhaps even why. Are they making money? Are they losing money? What's going on? But no one really ever spends any time talking about what endowments and foundations are doing. And some of these endowments and foundations have more assets under management than many, in fact, if not most, than of the hedge funds and private equity firms that are doing investing in the market. So what you can do is you can do a bit of modeling, because if you spend a few minutes with me here, and I'm using information extracted from Greystone Consulting to a survey done by Morgan Stanley, where they explored some of these large foundations and endowment funds and looked at what they invest in, which means you could actually, if you wanted to, just model what they do, or otherwise not, because perhaps your portfolio is doing much better than theirs. Anyway, assets under management is commonly abbreviated as AUM. So if you see that, it means assets under management. The average for an endowment fund is about $20.5 million. That's not really true. It's really true in terms of who responded to their survey. However, the median assets under management is under 1 million. That's a huge difference. The difference between the two is the average takes the biggest ones and the smallest ones and averages them all out. The median is in the middle. Half of them have more than 1 million and half of them have less than 1 million. The largest endowments belong to U.S. universities, like Harvard University, for example, has about $41.9 billion in assets under management. In fact, as I speak to you now, it's the largest endowment that I am aware of. And that's not small by any means, right? $41.9 billion. The typical U.S. endowment fund holds roughly 70% in traditional asset classes, which is probably much the same as you and me: public, private equities, bonds, cash, etc. Now, let's take a little deeper dive here and we look at what it is that they do. So the first thing that you see here is the size of the assets managed. And you can see that well over 50% of them fall into this large category. And once again, this is not all endowments and foundations. These are the endowments and foundations, or ENFs, that responded to Greystone Consulting's survey. But you can see that of the people who responded, more than 50% are quite large, with investments sort of in this orangey color and purple color here, sort of between $500 million and $5 billion. What about the types of institutions? Well, 36% of the endowments and 30% of them are private foundations. And so that's by far a greater majority, 66%. I personally have one of these public foundations, so that I also invest with and for and on behalf of other people. Anyway, so the market environment, the dramatic pullbacks in equity and bond markets of 2022, coupled with continued uncertainty about monetary policy, economic growth, geopolitics, appear to have dampened the expectations of ENF. So ENF, when I go through this presentation, is endowments and foundations, investment teams, both from an investment and fundraising perspective. Right, there's two tiers here that you're looking at. On one hand, you have the assets under management, which is the investment, and on the other hand, you have their fundraising activities, which brings in more cash, especially as it relates to universities who sell a useless piece of paper for an enormous amount of money, and then telling people if they have that piece of paper, they're going to get a well-paying job at Starbucks, for like $8 or $12 an hour. Investment expectations are muted. Only 1 in 5, so 20% of respondents, are very confident that their organizations will achieve their 3-year targeted investment returns. Now, there we have to be a little bit careful, because when we talk about statistics, sometimes they suit the narrative that the particular consulting firm is trying to share with you. And this is one of those examples, right? Only 1 in 5 respondents were very confident that their organizations will achieve their 3-year targeted investment returns. Why would Morgan Stanley say that? Because, if you work with Morgan Stanley, you'd probably be more confident. How do I know that? Because what they're doing here is they're looking at the sample of their respondents and saying only 19% are very confident, but wait a minute, almost 70% of them are confident. So if you take 70 and 20, that's almost 90%. Then you're down here to just 12% that are not really confident, right? So 88% Morgan Stanley are actually either very confident or confident that they will achieve their annualized return. 54% work with an investment consultant. Those who work with an investment consultant, says Morgan Stanley, do far, far better than those who don't. What are the top financial challenges of concern, right? So I highlighted the top 3 here because I think they apply to all of us. The market volatility is crazy, right? So energy was an example. Yesterday it was down 4%. Today it's up 3 and a bit or whatever. Generating an adequate investment return. Well, everybody cares about that, right? Because that's why we invest, right? To generate an adequate investment return. And the slowing economic growth and threat of recession. Well, if you live in the most developed country in the world, arguably, based on the size of the economy, the United States, then the slowing economic growth and the threat of recession is very, very real because the government is pretty much inept and probably, arguably, very, very corrupt. Interestingly enough for me, because on many, many occasions in past videos, I talked about inflation. And in fact, I refer to it as hyperinflation. It only made the sort of top 7, 8 year. And then the rest of the stuff, it's pretty much not that important in the greater scheme of things because you can tell by the respondents' percentage concerns, really the top 3 that I highlighted, and perhaps if you include risk management, of course, Morgan Stanley would include risk management because they offer clients risk mitigation. Expected donations in 2023 and 20 versus 2022. So this is an interesting one as well because expected donations work both ways. Like foundations and endowments make donations, but they also receive donations, right? They didn't actually qualify expected donations in or out here. What is interesting is that around 50% or just over 50% say they expect no particular change. Also, what's interesting is they gave you these 2 verticals here. One is less than $1 billion in assets under management, and the other one is greater, but they're all sort of more or less the same. No particular difference there. Asset class allocation as a percentage of assets under management. So here's where it gets a little bit more interesting because this may be applicable to you and I or not. So when you look at the allocation of assets under management, public equities, 34%, alternatives, and right there at the bottom, I add a little footnote that says alternatives include private equity, private credit, real estate, infrastructure, hedge funds, marketable alternatives, and commodities. Now, of course, to be fair, private equity, hedge funds, and commodities could also be invested in public US equities. So this number, once again, is a little bit skewed, which is pretty much the same thing that happens all the time when you talk about statistics. You can skew it or adapt it anyway to suit your particular narrative. And remember, much like Morgan Stanley, whatever it is that you do in business, you should always be selling. And as I go through the survey, Morgan Stanley is also busy selling. Anyway, about 56% in public US equities and alternatives, and then public non-US equity. So public non-US equity would be some of the emerging market stocks that we invest in, including people like you and I. When you invest in an issuer like Petrobras that's in Brazil or something like that, Ecopetrol, Colombia, those are publicly traded non-US equities. Of course, in my personal portfolio, in addition to those companies I just mentioned, I also have several Canadian issuers whose publicly traded equities I hold. The other thing that's interesting here, just for what it's worth, less than $1 billion, more than $1 billion assets under management, pretty much the same, right? The only difference is the larger they get, the more they tend to focus on public US equities and a little bit less on publicly traded non-US equities. Other stuff's pretty much the same. The other thing that you can sort of highlight here is cash or cash equivalents, only around 5 or 4%. Right now, I have far too much cash, but that's also as a result of some volatility and stops that I put in to protect some of my gains. Expect a change in allocation over the next 12 months. Now, this is also interesting from the point of view that 52% say they expect to increase their allocation over the next 12 months, 40% or so, no change, and then only 9% say they will decrease it. Look at the cash though, right? So 71% say they're not going to change it at all. So it's not like people are selling equities because they are running scared, right? So in the marketplace, there's lots of talk about recession and hyperinflation. Get out of stocks, buy gold, silver, and Bitcoin, etc. The large funds, endowments, and foundations in this particular example are not flooding into cash in terms of looking for protection in other areas. In fact, most of them have not changed their cash position at all. Alternative products for use or plan to use. So private equity and private credit, these are two big ones, right? So you can see on these lines here, alternative products and the percentage in light gray or blue here. Increase allocation over the next 12 months with 40% private equity, private credit, real estate. So once again, we separating them here. If they have less than $1 billion assets under management, they're looking to increase their stakes in private equity, private credit. And if they have over $1 billion, real estate and infrastructure. So infrastructure is an interesting one too, because you can only really invest in infrastructure if you have a lot of money. I mean, like people don't have the ability to say, I'm going to help to fund a bridge, for example, and use some of our endowment or foundation's money to help fund this bridge, and then attach all kinds of social impact investment strategies and impact deliverables against that. It's not a donation, it's an investment, right? So you hear people like Bill Gates saying, this is the best investment I've ever made. And then he's talking about things like the vaccine or whatever. So large foundations have the ability to make investments in infrastructure, as an example. The reasons endowments and foundations use alternatives. So this is interesting too. I've highlighted the top 5 to enhance portfolio performance. Diversify. Diversification is always good, right? Doesn't matter what you diversify into. Access idiosyncratic return sources. So these are different types of things, right? So I'll talk about that in just a second. Manage inflation risk and manage interest rate risk, right? So when interest rates go up, obviously debt costs more. So you want to kind of carefully hedge how you use debt. If you're using debt, for instance, if you're using margin calls in order to buy stocks, the inflation risk is something that you need to be aware of, because if you are generating single-digit returns and inflation is running, according to the government, at 8%, but according to people in the street, at like 30%, because most of their money is spent on gas and food and rent and things like that, and they've just gone up astronomically, right? So you need to figure out how you can manage inflation risk as well. The accessing of idiosyncratic return sources is an interesting one, because this could mean different things to different people. I have multiple various alternative investments as well, which includes products that we manufacture, that we sell. I have a charitable foundation gift shop where we can also sell things for cash. I have some investments in art and stuff like that, So I do have alternatives as well, but they're almost unique to every single foundation, endowment fund, or even individual people. So there's no sort of common thread there that you can use to tie them all together. Challenges to using alternatives, just very briefly here. Access to top tier managers and strategies, right? So how do you find this stuff? The length of lockup periods and other liquidity constraints, especially if you invest in a private company that's going public or something like that, you may not be able to turn those shares into liquid cash for a certain period, which is commonly referred to as a lockup period. So you just can't sell the shares, you have to hold them for a certain amount of time. Expertise required to perform due diligence, right? It's great if you want to, for instance, get into something that you think would be a great alternative investment, like let's say art. But if you don't even know where to begin, like how do you even shop for art? Or how do you value art? Does it even have any value at all, etc.? It's not easy to do when you haven't done it before. Accessing valuations and other data is extremely tough, especially when the companies are privately held, right? So unless you know the founder or the owner or the management team or something like that, it's really, really difficult to get information, because why should they give it to you, right? They don't owe you anything at all. It's a privately held company, so they can hold it as close to their chest as they possibly want to or can. high fees, right? So as soon as you go into an environment where people are giving you very, very specialized advice, like this YouTube video that you're watching now, which is worth millions of dollars. By the way, I don't have a Patreon account. Otherwise, I'd ask you to email me all the cash that you owe me. But high fees, right? So the more sophisticated the advisor is, the more valuable they think their advice is, the more they're going to charge you for it. In the good old days, we used to refer to it as 2 and 20, for example, where if you park your money with a hedge fund, they'll charge you 2% of your assets under management as a fee, and they'll take 20% of your profits, 2 and 20. Sometimes today, that's still in place, but maybe it's 1 and 10 or 1.5 and 10 or something like that, right? Time required to perform the due diligence. How much time do you have? How much time do you need? Is it going to be enough? Will you be able to find out everything you need to know? There are a variety of ways in which you can tap into information today, including just watching videos like this, because sometimes you find a real gem. But how much time do you have? Lack of transparency kind of ties in with accessing valuations and other data. It's very difficult to find all the information you need, and integrating those alternatives with the rest of your portfolio. How much you're going to allocate, etc., and what are you allocating it into? 82% of respondents who have a formal IC as an investment committee on their board, right? So this is actually very impressive because this number here, 60% of investment committee members actually have investment and or finance experience. That's very useful. It helps them a lot. Recapping the major themes from the survey, I've just highlighted 3 things here. Lagging confidence, right? The market volatility and economic uncertainty are dampening investors' confidence in meeting both performance and fundraising goals. However, working with a consultant, Morgan Stanley says, because you should hire Morgan Stanley, can increase confidence in meeting performance objectives. Fundamental challenges. Respondents appear to be less concerned with recent timely issues like rising interest rates or inflation. I don't know about that, right? They appear to be less concerned. I'm very concerned about rising interest rates and inflation. I think it's time for the Fed to stop raising rates in the United States because other central banks across the world just copy. And I think rates are probably at their peak in terms of where they arguably should be in terms of trying to arrest hyperinflation. Instead, they identify more fundamental challenges such as meeting investment goals and managing risk as pressing issues. Well, one of my primary challenges is also meeting my investment goals. I'm not really greedy in that regard, but I do set myself a target. So for instance, on my publicly held equities, I'm looking to achieve 15% per year. I don't always get there. Some years I do 40% or more, and some years I come in at negative or maybe single digit numbers. But over a period of time, I want to sort of average around 15% per year in my publicly traded equity portfolio. I have other investments too that should deliver a lot more than that. But for sure, in terms of my publicly traded equities, that's the kind of return I'm looking for. Smaller endowments and foundations are aggressively looking to increase their alternative allocations in the next year. Well, that's interesting to know as well. Just in terms of the weighting of different asset classes in their portfolio, and I'm going to wrap it up here. 51% bonds, 51% equity, so publicly traded stocks, or which could be domestic or foreign. 7% bonds, 14% real assets, 25%, that's quite a high number, absolute return, and 3% cash. The 3% cash seems to be quite consistent. What is absolute return? So here at the bottom, I gave you a definition. Absolute return funds use a variety of investment strategies such as derivatives, arbitrage, short selling, leverage, futures, options, unconventional assets, right? So a little bit more sophisticated, a little bit more tricky than what the average person might be able to perform out in the market. What is interesting though is if you take into consideration 51% equity, 7% bonds, that's almost 60%, and then you add in 3% cash, 63%, and then take into consideration that many of the items here at the bottom, the derivatives, the futures, options, etc., are also really equity as well. So if you add that all together, they pretty much invest in the same stuff that we invest in, including real assets. So that's a wrap on this video. So maybe you can compare your own portfolio and sort of see what yours looks like in comparison to these guys, the smart guys, right? The smart money in the room. And of course, as I said at the beginning, Morgan Stanley is selling, as everybody should be if you have a product or a service that you should be selling or want to sell. So make sure that you always keep in mind that you should be selling when you have an opportunity to speak to people, including when their research firm speaks to us. For the next video, I'm not sure the very next video, but perhaps if not the next one, the one after that, I am actually going to share a small cap mining company with you that I found that I think might be really interesting. It's outside of my wheelhouse. It's predominantly gold and silver, but I have done a lot of work over the past couple of weeks, and I actually just had lunch with the CEO in order to learn more about the company. So that's my little teaser for, let's say, for next week. So sometime during the week, maybe next week, which is the week of November 20th, I'm going to see if I can nail down a meeting with the CEO of this mining company that I'm talking about. And maybe we can get online for 15 or 20 minutes and educate you about this investment opportunity, which I think you might like. So on that happy note, this is Rudy signing off saying thanks for watching. Take care. Bye-bye.